welcome to Market Overtime. I'm Oliver Renick. Thanks for tuning in to our long-form interview series. My guest today is one of Wall Street's most recognizable stock pickers, a career tech analyst who rose to prominence in the dot-com era and has been glued into every big tech theme since, from the software boom of the COVID era to today's AI behemoth bull market. Dan Niles founded Niles Investment Management last year after running the Satori Fund. He's been a regular on our show for some time. Last year he called for a big rally, but it seems like this year's outlook a bit more complicated. He's joining us here for Market Overtime. Dan, thanks so much for your time. Appreciate you being here.
Oh, my pleasure, Oliver.
You've got a really interesting background. We've talked a lot of stock picking, macro. We're going to get to that, but I kind of wanted to just talk a little bit more about Dan Niles himself. You're also an engineer, which I didn't mention in the intro, by education. So was I. How quickly did you pivot out of that?
Well, I started investing actually as a sophomore in college. Met a girl there, now my wife. I've been with her since 18, and she switched from electrical engineering into finance and got me interested in it. And so when I graduated with my master's out of Stanford in electrical engineering, I'd worked for Digital Equipment Corporation for 3 summers. I decided, you know what, I'll give investing a full try. And so in 1990, I got into the world and haven't left.
You did your bachelor's at Boston University, BU, systems engineer, Stanford master in electrical. How often do you find today the stuff that we're talking about in the stocks and the companies that you're thinking about, do you draw on that knowledge, any of that kind of more academic scientific rigor in the background? Do you ever find yourself tapping into that?
Yeah, I find myself using that a lot, and what's also helpful is one of my sons, he's actually a computer science, he graduated with a degree in computer science at University of Chicago and with a minor in artificial intelligence, and so he's doing his own startup, and so when I have to get into the weeds, it's always great getting his opinion as well in terms of the cutting edge, quite honestly, of what's going on in AI. So I use every resource available, CEOs that I talk to down to my kids, and all of it's very, very helpful.
That's cool. Last year you started investment management, Niles Investment Management. You're still running the Satori Fund. How did those two interplay, and what was the purpose of launching the investment management vehicle as well?
Yeah, for me, I've always had partners. I started my investing career with Lehman Brothers. Obviously, we know what happened there. And then I've had a couple of partners since, and I had a chance to run it all myself and run my own firm. And so that's what I started doing in April. And it's been terrific, but really no change to how I invest over the last 20 years.
Last year, when we spoke early on in January, you had some big tech top picks, Meta, Amazon, you were looking for biotech, China internet too, but your overall theme was that stocks were likely to post a big rally, a pretty aggressive price target that we got to. Tell me about what we learned last year and how that informs your view for this year, which seems to be maybe a little bit more kind of nuanced, cautious. I saw that you've got a pretty big cash recommendation as well, so let's kind of go in the time machine real quick. What was 24 really about in your mind, and what's changing at this juncture?
Yeah, so when I went into 2024, my prediction a year ago was I thought the market could be up 20% if the Fed engineered the first soft landing since 1995. And obviously the market ended up 23%. The Fed did in fact pull off that soft landing, and they were cutting rates. And so that started in September. And so there's this old saying, and I've been using it for a while, which is don't fight the Fed. And that's really held true for the last 4 years, or you could say don't fight inflation. And so coming into this year, my issue has been the following. Things don't matter until they do. And what I mean by that is inflation at the beginning of 2021, CPI went from 1.4% to 7%. And you go, oh my God, that's huge. Yeah, but the market rallied 27% because nobody cared because the Fed said it was transitory. Then we got into 2022, and the Fed was like, oops, not transitory, started raising rates, market went down 19%. So if you look at where we are today, headline PCE bottomed in June and has started rising since then. If you look at core PCE, headline CPI, core CPI, all of those metrics bottomed in the third quarter and have been going up. But the stock market obviously didn't care. Right up until December 18th, when Jerome Powell said, our inflation forecasts have, quote, kind of fallen apart, and then the market went down 3% that day. Bonds sold off sharply, yields surged, and that might be the tipping point, much like when the Fed said inflation wasn't transitory. And so I look at this year and I go, I think there's almost a 50% chance the Fed doesn't cut at all and potentially raises. And in that scenario, with the trailing PE of the S&P at 25 times, when normally it's around 19 times when you have CPI between 2.5 to 3%, which is where it is now, that doesn't leave you a lot of room to maneuver, and you could get a very sharp multiple contraction in that scenario, even though growth is very, very good, just like it was in 2022. So that's kind of the detail behind it.
We get a little taste of that, it seems, the last several weeks of 2024. Market buckled a bit as yields pushed back to highs. Do you see that kind of potion has already begun brewing?
Absolutely. If you think about it, the Fed has cut rates by about 100 basis points since September. The 10-year treasuries have gone up 100 basis points since the Fed started cutting. And you've seen some of the data that's come out recently where the JOLTS data that came out this last week, or the ISM services prices paid numbers that came out, were all hotter than expected, stronger than expected, and the market sold off on that. So right now at 4.7%, you're bumping up against the highs you set, several months ago, but the market's a lot higher than it was back then. And so, you breach this 4.7, I think, on the 10-year treasury, and you're going to have a very big problem in the stock market. That's just from a multiple standpoint. I've got fundamental concerns too, which is when companies report and guide, the S&P 500 especially, you've got 30% of revenues outside the US that's got to be translated back into US dollars. Well, the dollar's gone from 101 at the end of Q3 to 108 at the end of Q4. And so you immediately are going to take a 7% hit to that 30% of revenues that come internationally. And if you look at the Magnificent Seven, some of those names have revenues closer to 60% outside the US. So all of that stuff you're going to have to deal with, not to mention things like there's no Olympic ad spend this year. There's no spend on the costliest election in history. That's going to affect the advertising companies. And then don't forget Easter moves from March 30th last year into April 20th this year, or maybe to April 20th this year. And so e-commerce companies, advertising, again, that demand's going to shift out from Q1 to Q2. So there are a lot of things, even on the fundamental side, where you could end up with estimate cuts when companies guide.
So then it seems like we're going to miss a few of those potential kind of bonuses for growth. And then you add in what's happening in bonds already to kind of disrupt the apple cart. Is there an equivalent then kind of short case to be made, or do you see it more as an avoidance of being overly levered long? Cash being one of your top picks. Are there any obvious shorts to play in this, Dan, or is this more just avoidance?
No, I mean, I think in the stock market, there's always stuff that's going to go down hard and stuff that'll rally. I think the big thing that people aren't focused on is all the AI-related stocks, because for obvious reasons, people are really, really bullish. But you've had multiple developments over the last several months that speak to the fact that AI CapEx is probably going to slow down dramatically as you get into, or as you're in this year. And so you've had the hyperscalers spend about, close to 60% more in CapEx in 2024. Now, if you look at 2025, I think you're going to see that spending go from close to 60% growth down to a number that's closer to 10 to 20% growth. And if you look at what Microsoft actually said on January 3rd in a blog post, they put out this number that they're going to spend $80 billion in CapEx, and everybody's excited, saying, oh my God, that's great, that's up 44%, but that's a fiscal year. If you work backwards through this, and I've actually posted on this, they spent $20 billion in CapEx in the September quarter. They guided for that to increase in the December quarter. So that's over $40 billion. Well, their fiscal year ends in June. So if you say, well, they're saying $80 billion for the full 4 quarters, but they're going to spend over $40 billion in the back half of 2024, that means that number is actually going to go down in the first half of 25 relative to 24 after this big surge that you've seen. So that's going to affect a lot of companies that were supplying into Microsoft. And Microsoft, by the way, is widely acknowledged as the biggest spender on AI CapEx in the world. And so that's a pretty big issue if you go from growth that was running close to 80% year over year to negative by the time you get into that March-June quarter.
Is it worth trying to time that transition period? Because then I would guess there's still some runway for the first half of the year, or is that getting too fancy?
Well, I mean, as I said earlier, it's all about when the market acknowledges there's a problem. And so, like I said, with inflation, right, it goes from 1.4 to 7% in 2021, and the market's up 27% because people just want to ignore it because the charts look good. Right? And so people look at the charts and they go, oh, well, the stock market's up. Clearly there's no problem, which is, very stupid to think that. But the key to making money is you want to know what's going on fundamentally, and then you want to wait and see when you think the market might be acknowledging it. Now, is NVIDIA reversing a couple of days ago from after they finished CES and the stock opened up, hit a new all-time record high, and then closed down 6%. Is that a sign of people starting to think about that, or is that just more sell than news? And people worried about the fact that on Friday we're going to have some more, restrictions on AI chips being sold to China and other governments that might not be friendly to the U.S. We'll have to wait and see, but I think you're going to have obviously a lot of companies report their December quarters and then give outlooks on CapEx for next year, this year, 2025, and you can do the math and figure out. And unlike with Microsoft, most of the other big spenders are all calendar years, ending in December. And so it'll be very easy to do the math on that and go, okay, well, what is spending doing? I know what it did last year. How's it growing this year? And then work backwards. Because if you look at Microsoft in particular, that massive ramp up in CapEx really hit their cash flow hard. So the fact that that's going to go negative, that's actually a good thing for Microsoft in terms of their cash flow. The stock was only up 12% last year, with the market up 23%, and obviously massively underperformed other names related to AI. That may actually help it on a relative basis do better this year because you don't have this huge hit to cash flow. So a lot of stuff in there, but a lot of it's just trying to figure out when does the market care. We actually, do have some very negative views on a few of the AI related names, but we're constantly adjusting how we think about it depending on what the market's thinking, right? We don't want to be caught in a 2021 situation.
And to connect a few of these points, do you view the bond market as possibly being the kind of pen that could kind of prick some of this bubble, or do we not even need a cause when some of these companies are trading as expensive as they are, just whenever sentiment runs sour?
Well, there are two big concerns. The big one is obviously the bond market and inflation, which we talked about. And President Trump, he's got a lot of great growth policies. But don't forget, the economy is already very strong. Unemployment's at 4%, and GDP is growing at 3%, and you've got a pro-growth policy coming into place. But the problem with that is that's also inflationary. So the bond market should scare you because of multiples. And then if you have an issue with an AI-related company, especially on the chip side, talking about slowdowns, or the big hyperscalers as in Amazon, Microsoft, Google, etc., or Meta, that's the other side of the equation, because obviously, really since COVID, those stocks, when you had first a big investment for COVID, as everybody had to stay home, get online, and then the second round for the last 2 years when AI kicked in with the introduction of ChatGPT, you've had these mega cap tech stocks really driving the entire market. And if we go through an AI digestion phase, that's going to crush multiples for 30% of the S&P, which is what the Mag 7, I think it's more than that now, make up. And so that's the double whammy: inflation, market multiples on the one hand, and then AI on the other.
Dan, what is the possibility that the services and the products for not just commercial entities but individuals and everyday consumers disappoint on the AI front? Because I feel like that's something that we'll really test this year, whereas the last year was just hardware build out mostly, and the kind of arms race for building out all these hardware and data centers, which was kind of an easier first step to kind of lower risk, like, okay, we just know we need to have this computing power. Now, how to deploy it to the consumer. I mean, there's a few products, right? We've got like the Apple Intelligence, we've got Microsoft Copilot, people can use ChatGPT and others, some on a subscription basis. So there's some stuff out there, but is it compelling and big enough to sustain and justify the spending that went into 2024?
Well, that's the problem right there, because you've got a lot of talk about, oh my God, Apple's going to launch Apple Intelligence. And then what did they do when they reported the third quarter? They guided below the street for the December quarter because the Apple Intelligence features weren't good. And you were getting an incremental rollout of those features in the US. In Europe, you don't even have those features rolled out. And we don't know if we'll ever get those features on iPhones in China. So smartphone AI has not been a driver of demand, at least for Apple and iPhones, if you just look at what they did when they guided for December. And there's nothing that says right now that it's particularly going well in terms of when they report the December quarter either. On the PC front, same thing. There was a lot of talk about AI PCs driving a big upgrade cycle, and it just hasn't happened. Because there's nothing compelling where people are going, oh my God, I have to use this. And so on the hardware side, you've invested a ton of money on the AI infrastructure, but ultimately the US economy is a services-led economy by the consumer. And if the consumer is going, well, I don't really care about the AI features on my smartphone because they're not that particularly good, and I don't really need them on my PC, then at some point you have to justify the return on investment, which is the big issue. And I've been talking about this and writing about this for the last 6 months in terms of I thought there would be an issue this year, because you haven't seen this pickup in demand for the actual devices at the edge that use all the infrastructure spending for AI at the core. And that's the problem. The edge is not seeing the demand that you need given the amount you've spent on the core.
Yeah, it's something we talked about in a few of our last conversations with Apple, that it didn't seem like a super compelling case for a massive refresh cycle. So it kind of seems like the early indications, maybe that's the case. So cash kind of being a top pick, and you view that as like a money market fund, basically. What kind of return do you think is reasonable? People, I guess if rates keep going up, then they might have some more entries for even higher income levels too.
Absolutely, because money market funds right now yield over 4%, right around 4.5%. That's great because it also gives you dry powder. If you get a really big sell-off, it gives you the ability to deploy that into stuff that might be get oversold or that you think are fundamentally okay. And so I think, will the stock market return more than 4%? That's an open question in my mind.
Yeah.
Obviously, I've got 4 other picks of my top 5, and your viewers, or we can talk about it now.
Cisco's, it seems like the number 1 tech pick. Is that right?
Yeah, Cisco's one that's just been a dog for a long time, but I think there's some things that are changing right now. Think about it this way, the last 2 years you spent all this money on AI infrastructure and you're generating all this data. I think 2025, you're gonna have corporations trying to move that data around, network to that data, and that's where Cisco is gonna come in. And also Cisco has also developed some internal silicon that'll help with this process. And if you look at last quarter, they had 4 of the hyperscalers, web scalers, grow orders over 100% year over year. And so I think you're starting to see that take hold. And the stock trades at a 16 PE. The S&P is at 25 times. A few years ago, I picked Oracle as one of my top picks, and because it was a legacy tech company, it had been really not doing much of anything. And now look at what the stock's done over the last few years. And I think Cisco has the opportunity to sort of be like Oracle was several years ago. So we'll have to wait and see. Something related to that is Adtran, where they are basically going to help the European telcos, because they service the telecom guys, drive fiber to the home in Europe. So British Telecom, Deutsche Telekom is doing that so people can get access to all of this great capabilities. And in the US, you're going to have BEAD funds, which will start to roll out from the US federal government, that's going to help get broadband to underserved communities in the US, and that's going to start to roll out middle of this year. And so you look at Adtran and their valuation relative to their big competitors, Calix or Ciena, and beginning of the year, it was like roughly half those levels on an EV to sales basis. And then if you get some of the balance sheet improvement that I think you'll get, because they've got a debt sitting at 8%, which I think they'll be able to go ahead and get off, that's going to really help them out as well. The other one was the bank ETF, KBWB. There you've got these pro-growth policies, you got tax cuts and deregulation that should really help the bank stocks. The S&P's been up 23% over the last 3 years. The KBWB's been down about 4%. Partly because, don't forget, in 2023, you had all those bank failures, Silicon Valley Bank, Signature Bank, First Republic. And so they've really underperformed, but the policies of this new administration coming in should be great for bank stocks, great for M&A. You've obviously seen a lot of M&A deals already announced. And then the final pick is the mid-cap ETF, because, as I said earlier, the last 5 years, it's all been about investing in COVID, and then the last 2 years, it's been about investing in AI. These mid-cap stocks have been left for dead. They're trading at 17, 18 times versus the S&P at 25 times trailing, but I think you're going to see pretty good growth in that space. And they're very defensive, actually, if you go and you look at the stats in terms of how they performed during 2022 when you had high inflation, and even when the tech bubble broke back in, obviously 01, 02. And so that space, with the S&P up 82% over the last 5 years, the mid-cap the mid-cap value index, to be clear, so IJJ.
Yeah, that's IJJ.
Yeah, that was that underperformed by about 35% over the last 5 years. So I think you're going to see some catch up there.
Like those picks. Want to go back through them real quick. Adtran for the complementary kind of small cap tech play for networking, comm equipment, ADTN. The bank, KBWB, I think that's an interesting way to express it, as opposed to the KRE, pure regionals, which underperformed KBWB pretty significantly over the past year. So it sounds like you don't want to wade entirely into kind of the lower quality edge of the banks.
Yeah, because especially if you have inflation, smaller names tend to underperform. So I want a mixture of some of the biggest banks in there as well. So that's why I like the KBWB. And then that's why I also picked the mid-cap value, IJJ, versus the small cap value. Small cap tends to do a lot worse when you have a problem with the stock market, because they're just smaller companies, right? They can't handle it as well as the slightly bigger ones. And I've written about the performance difference between those, and your viewers can look at that. Yeah,
you kind of are able to put more of like a higher quality almost filter on it just by going up the cap spectrum, as the Liz Ann likes to say here. Dan, the point real quick on the banks and connecting to the potential for bond volatility, given that the duration problem was at the heart of the regional situation a couple of years ago. How does your view of potentially higher rates or problematic inflation mesh with that? Do these two complement each other, or if rates blow out, do you back away from the bank trade? How do those two interplay?
Well, yeah, I mean, obviously, you've got all the moving pieces going on at the same time. I think the good news is you're going to have a much stronger capital markets, right? A lot more M&A going on, and so that should help the fee-generating income portion of the banks. The other thing is the yield curve is steepened. So if people are, you're giving them X when Oliver Renick and I put our money into the bank, but they can lend out at a much higher rate than they were able to before, net interest margins are going to be higher, your loan growth is going to be better, and so they're going to generate a lot more income from that. And so I think that's the other thing that helps. So a lot of this is obviously in 2022, when we had cash as our top pick, then it was very hard to find anything that went up. And so, and recommending shorts is, it's not something that they're hard to manage, obviously, because you have unlimited loss capability, and you can only make 100% if a stock goes to zero.
Totally.
So what people should take away from this is, if you think the market at best can go up 10%, but you think it can go down 20 to 30, you want to be very, very careful, and that's why cash was our top pick.
Well argued, and also a very good point that I think a lot of folks miss on the banks too, that even though yields are going up, again, it's a totally different shape, which is much more favorable to them in 22. The kind of lingering subjects from last year, a few that kind of had moments of glory then faded, the China trade, the biotech trade. What do you think about those, Dan, just kind of as a last thought, and worth another stab, or leave those behind?
Yeah, China, the problem, well, it's good or bad depending on how you want to look at it. China, their leader has said he views, handouts as akin to welfarism. So they have an ideological view against handing out, checks directly to consumers, and so they're going to keep that controlled. What they want to really do is stop the drop in property prices, shore up their banks, etc. But you're not going to see the large-scale stimulus you've seen in Europe and the US, which causes problems on the other side, which we saw with massive inflation. So I think, for me, I'm looking at the space because the valuations are ridiculously compelling relative to the US, and they've gotten even more compelling with what's happened. But it's really hard to say you want to go into China when President Trump is going to start off with tariffs immediately. And maybe and I don't think they're going to be as bad as people think, and so that might create the opportunity. So I'm kind of looking at that. Okay. With the biotech stuff, I think you're going to see a ton of M&A, and so that's actually pretty interesting, because the valuations there have obviously continued to be depressed, but you can't get any M&A done. Well, that's about to change for the next 4 years. And so that space starts to get a lot more interesting, because at the end of the day, I kind of called it the simplest investment thesis is nobody wants to die, right?
Right.
And biotech is at the heart of trying to make sure that you can live longer and you don't die. So with that and valuations where they are, it's interesting. So
love it. Joachim's razor case for investing. Love it. Dan Niles, thanks for the details. Very interesting view on this year, distinctly updated and different one from last time. So like the active thinking, very helpful for us. Appreciate it. Thanks a lot.
Thank you, Oliver.
Good stuff. Dan Niles, founder and portfolio manager at Niles Investment Management. Great stuff on the look ahead for 2025 and how it might differ from the pretty much straight up market of much of 2024. Catch all past and future episodes of Market Overtime, by the way, of course, on schwabnetwork.com, YouTube, and Spotify. Be sure to subscribe to all of our channels. I'm Oliver Renick. Thanks for tuning in to Market Overtime.